We're delighted to have been able to report interim results for the first half of the financial year today, and those results are in line with our expectations. So for the first 6 months of the financial year ended 30th November 2018, we originated over 80 million of new business. We recorded revenue of 16 million, profit before tax of just under £4 million. And that's a very good set of results in comparison with this time last year. What underpins those results is a few factors. Firstly, the culmination of our buy and build strategy over the last 3 years, where we've acquired 7 companies, combined with the fact that we now have a wide product range of finance for small businesses in the UK. So that's asset finance, vehicles, loan and invoice finance, plus the fact that we've continued to operate our flexible model of being both a lender and a broker to other lenders. And in the past 12 months in particular, we've focused on organic growth, which has enabled us to accelerate becoming a fully fledged group rather than the collection of individual companies. And I think all those factors underpin the good performance for the first half of the financial year.
Somewhat bizarrely, I'm going to start with an apology and then quickly retract it. The apology is because what I'm going to say now is very similar to what I said 6 months ago and 12 months ago and 18 months ago and 24 months ago. So there is an element of repetition here. However, I will retract the apology because the reason I'm able to say this is because of the consistent and solid performance of the business and the hard work and fantastic effort of the 185 staff we've got across 7 sites, which means yet again I'm able to be in the proud position to report a set of numbers with big green ticks next to every one of our financial metrics. Deal origination, which is the lifeblood of the business and will in time become the future revenue and then profit of the business, is up by over 10% to over £82 million. Our revenue has topped 16 million for the first time, which is some 10% above prior year comparatives. Our profit before tax is just under 4 million at £3.9 million for the 6-month period, which is some 11% up on this time last year. And our earnings per share is up 12% to 3.63 pence per share. So a really strong profit-based set of numbers. If we look at the balance sheet, that's also in very rude health. Our net assets have topped 50 million for the first time, coming in at just over £51 million. And our own book portfolio, which is the amount of businesses we've lent to UK SMEs, has topped 142 million. So the balance sheet is in a very strong position as well. Some of the other key financial metrics we look at are our cost of funds, which is the amount it costs us to borrow funds from other lenders, which we then lend on to UK SMEs, continues to fall marginally this time to about 4.0% for the period, compared to 4.1% for the 12 months to 31st of May. Our funding facilities from our funding partners continue to grow. They're just under 170 million as at the 30th of November, compared to just over 162 million back on the 31st of May. And crucially for us as a balance sheet lender, our bad debt write-offs, our net bad debt write-offs, which is the difference between the amount we write off and what we recover, has remained relatively static and even marginally fallen from this time a year ago. So given the current economic environment we faced and have faced for the past 6 months or 12 months, I'm delighted to be able to report these numbers.
All of the businesses that we've acquired during our buy and build phase have been well-managed, successful businesses in their own right, entrepreneurial and very sales focused. Our integration challenge has been to support that sales focus with corporate discipline, compliance and back office functions to help those businesses be more efficient. So we have invested in people, in experience and in expertise in areas such as credit risk, i.e. underwriting, in compliance, in HR, finance, marketing and systems, all with the aim of accelerating our integration as a group rather than being a collection of individual companies. So that investment that we've incurred has caused an increase in cost of about 20% in comparison with this time last year, but that future-proofs us for further development and further growth this year and beyond, and therefore we won't need to incur the same level of investment going forward.
We're only able to do what we do thanks to the support of our funding partners. And we're in the strong position of continuing to be supported by all of our partners and continuing to have interest from other partners to come on board as well. As at the 30th of November, we had funding facilities in place of just under £170 million, which gave us headroom of just over 70 million to fund future growth. So we're in the enviable position of having funding facilities in place to see us through for the next 2 or 3 years of our strategic growth plan. Given the current economic environment, we think that's a very strong position to be in. And we continue to benefit from economies of scale of being a bigger group and able to draw down ever larger funds from our funding partners, which means that the rates they're able to supply them at continue to fall. Clearly, there is potential for interest rate rises in the coming periods. Crucially, the funds that we have lent out for asset and loan businesses are fixed. So one, what we charge to our customers, and two, what we've drawn down from our funding partners are fixed. So they aren't impacted by interest rate rises. However, if interest rates were to rise, that could impact new business we write, but we remain confident that the increasing economies of scale and the new facilities we may be able to put in place over the coming months will mean that our funding rates and our cost of borrowing will remain the same or maybe even marginally reduce.
Many of the businesses that we lend to are what I call staple diet businesses. So these are businesses that provide goods and services that we all require on a day-to-day basis. So demand from those businesses is pretty robust. If you align that with our multi-product offering, so providing all the different finance products that those small businesses require, that combination means that demand has been robust and has held up well during the first half of the year. That said, there is a plentiful supply of wholesale funding around, and that has caused some pressure on the interest rates that we're able to charge. Our response to that has been quite resolute, in that we're not going to relax our credit criteria or to drop our prices to chase top-line growth, because we've been able to deliver a good level of organic growth by maintaining our margins and sticking to our credit policies. In addition to all of that, of course, there is the current uncertainty of Brexit. I've said before that Brexit is both an opportunity and a threat for us. The opportunity is to lend more money to those companies that require some support during what will be an uncertain cash cycle over the next few months. And clearly the threat may be that some companies will have cash flow difficulties, and that might be a challenge for us in recovering all of our receivables from transactions that we've already entered into. But again, our response to that is to ensure that we are carrying a bad debt provision that's twice the level of the rate of write-offs that we're incurring. So trading conditions are competitive, but we're seeing a steady demand, and that's what's allowing us to achieve and continue with our organic growth during this current financial year.
It's not often that I take the opportunity to talk about a change in accounting standards, because it can be seen as quite a dry subject matter. However, IFRS 9, which is reported for the first time in these interim numbers, is crucial to balance sheet lenders like ourselves. I won't go into detail and the nuances of it, but at a high level, what it does is take the art out of provisioning and turn it into a science. Now, we've done a number of very complicated and detailed modelling exercises, and the very pleasing thing for us is that despite the adoption of this standard, we've only had to restate our prior year balance sheet by £185,000, which is 0.1% of our own book portfolio. And I believe, and the board believe, this reflects the cautious and prudent approach to provisioning that we had already undertaken in prior periods. The interims are the first period where we've announced an interim dividend, and that reflects the announcement we made in July of 2018. Dividends are a very emotive subject, and we have one side of our shareholder base who like us to increase dividends to get more short-term rewards, and another, probably equal and opposite side of our shareholder base, saying don't pay any dividends, we'd rather you keep the money in the business and generate future profits. We felt the progressive dividend policy we announced in July was a very happy medium, getting more rewards in the shorter term to our investors, but still keeping significant dividend cover. And we're very pleased to be able to honour that and announce a dividend of 0.28 pence per share, which will be paid on the 1st of May to shareholders on the register at the 1st of April.
We have a lending portfolio of £142 million at present. We see no reason why we can't increase that lending portfolio to £350 million over the next few years. So our focus will be on organic growth to start with. We clearly have an aspiration to continue to grow all of our businesses organically, but there will also need to be some inorganic growth to achieve those targets. It's a fragmented sector, so there are plenty of opportunities for us to consider, but the valuation conditions have to be right on both sides. And what I mean by that is that if we're going to use our listing to issue shares to raise money to make acquisitions, the valuation of our shares has to be right in the first place. And equally, the valuation of the target companies we're looking to acquire has to be right. So we will look at that when the conditions are favourable. But in the meantime, we'll focus on organic growth. But going forward over the next few years, our strategy is clearly to do both organic growth and further acquisitions when it's appropriate to do so. The outlook for the remainder of the year is positive. We're tracking in line with management expectations at the half year. There is a slight second half weighting in our numbers because we're organically growing, but we're confident that the level of demand that we're seeing, which is steady, will continue to come through in our results for the full year. 185 colleagues around the country are working very hard to deliver good customer service every day, but they're also very conscious that their ultimate job is to increase shareholder value for the owners of our business, and that's what we're aiming to achieve. Our collective purpose is to grow together. We have a goal of becoming a specialty finance provider of choice in the UK, and we're all working hard to achieve that on a daily basis.